Good morning. I'm Hugh McNeill, co-chair of the Professions Economics Member Interest Group and partner at Cabot Square Capital LLP. Welcome to the fourth event in this year's 5-event Thought Leadership webinar series, Finance in the Public Interest 2022. I'm delighted to be chairing this event entitled Long-Term Investment Returns in a Net Zero World. These webinars seek to build on the original Finance in the Public Interest series from last March. They also aim to provide a forum for dialogue on the questions posed in the Frank Reddington Prizes, the profession's inaugural thought leadership essay competition, on the twin themes of financial regulation and the sustainability of pension systems. The series itself is part of the profession's wider 2022 Thought Leadership Programme, which seeks to bring together leading experts, thinkers and decision makers with our global membership to debate key issues of our time, particularly those intersecting with both actuarial practice and the interests of wider society. Through the series, we will provide a platform for prominent contributors within our own thought leadership community so that our members and others can understand the perspectives of a wide range of parties. In due course, you'll also be able to re-watch on demand the full video recordings via the profession's virtual learning environment and our YouTube channel. The Frank Reddington Prizes have been generously sponsored by Milliman and Punter Southall. The prizes focus on two areas where the profession is using its expertise and insights to challenge orthodoxy, encourage fresh strategic thinking, and in some cases, make radical challenge, which supports our public interest commitment. The prizes focus on two such issues, welcoming the best ideas from within and beyond the actuarial profession. The deadline for submission is the 13th of May this year, and I strongly encourage you all to consider entering the competition if you feel inspired. Further information is available on the profession's website. So without further ado, it's my pleasure to introduce you to our speakers, Professor Aled Jones and Scott Lothian. Professor Jones is the inaugural director of the Global Sustainability Institute at Anglia Ruskin University. Aled's research particularly focuses on the financial and governmental sectors and how they will respond to the impacts of global resource trends and climate change. He was lead author of the report of 2013 to the actuarial profession on the implications of natural resource constraints on economic growth. He was chair of the working group under the Capital Markets Climate Initiative on behalf of the UK Minister for Climate Change at DECC, and is a member of the UK-US Task Force on Extreme Weather and Global Food Resilience. His work in climate finance has been recognised by the state of California, and he's received a key to the city of North Little Rock, Arkansas. And last, but by no means least, in 2018, he was made an honorary fellow of the Institute and Faculty of Actuaries. Welcome, Aled. Scott Lothian joined Baillie Gifford in 2015 and is an investment manager in their multi-asset team. Prior to joining Baillie Gifford, he worked for Schroders in London, BEA Union in Hong Kong, and prior to that, Towers Watson. Scott graduated with a BSc in Actuarial Maths and Statistics from Heriot-Watt University in 1999. He's also a fellow of the Institute and Faculty of Actuaries. So welcome, Scott. Before I hand over to our speakers, I'd like to spend a couple of minutes just giving some context. Firstly, some of you may not be familiar with the profession's Economics Member Interest Group. The Economics MIG was formed to coordinate our member community's response to a report produced in 2019 by Dr. Ian Claycher at Leeds University Business School. Dr. Claycher's report took stock of the use of economic theory in actuarial practice, to be sure that as users of economic theory, we as a profession use that theory fully, but appropriately. The report identified 6 areas for further work, which are briefly summarised here. In the interest of time, I won't go through them in detail, but I encourage those of you who are interested to view the report, which can be found on the profession's website. One of the key aims of our session today is to continue the process of carrying forward those areas of work. So I put this slide together in the hope that it can help provide an overarching framing for the conversation today. Most of it, I hope, will be self-evident, but it's my experience that getting very clear on which part of the overall system we're talking about can be very helpful in thinking through particular issues that we may be considering. Firstly, whilst obvious, we often lose sight of the fact that everything is dependent on our natural systems. Without our planet's biosphere, life would be impossible. Nested within the natural system of the biosphere is what I've labeled the human-made physical system. This is the physical economy that deals with the flow of goods and services, those things that are intended to meet our human needs and desires. The third system is itself a subsystem of the human physical system. It's what I've labeled the financial system. The job of the financial system is to allocate the results of human activity between the different actors in the economy. In essence, it deals with claims on the outputs of the first two systems. I should also highlight that the financial system is predominantly where actuarial practice is focused. Finally, each of these systems interact with each other, with both positive and negative feedback loops. For example, the impact of credit crunches in the financial system is often to constrain activity in the human-made physical system. In a similar way, the impact of the recent COVID-induced lockdowns was to temporarily curtail carbon emissions from the human-made physical system. And finally, increased weather variability in the natural system is leading to more frequent and severe instances of weather-induced destruction of human-made physical infrastructure, which in turn has impacts on the financial system. Ultimately, they're all linked. However, it's arguable that the economic theories of the 20th century that were fit for a world that had no pressing natural system constraints are likely to face challenges in the 21st century, where that is no longer the case. This is why Kenneth Boulding said, anyone who believes that exponential growth can go on forever is either a madman or an economist. Whilst the session is entitled Long-Term Investment Returns in a Net Zero World, we can't ignore the broader context. Many of you may be familiar with this diagram produced by the Stockholm Resilience Centre. Based on work by teams of researchers led by Persson and Stefan, it depicts 9 planetary subsystems and the impact of human-made systems on those natural systems. It highlights that, in the considered opinion of the research team, human activity is taken as well outside the safe operating margins of many of those subsystems. Other key areas of overshoot identified are the integrity of the biosphere, the impact of man-made pollutants such as the so-called forever chemicals on natural cycles, the impact of land system change, for example, of unsustainable soil erosion, and the disruption of fundamental nutrient cycles. So when we talk about net zero, we need to remember that CO2 emissions are just one of a number of critical constraints that may lead to disruptions in the natural, human-made physical and financial systems. The challenge we have is finding appropriate economic tools to allow us to help our clients and communities successfully navigate the challenges on the horizon. So having set the scene, I'd like to hand over to Professor Jones to expand on those areas, given his particular focus on the larger systems view. Alid, over to you.
Thanks, Hugh. Thanks everyone for joining. We look forward to the discussion at the end, because I think there's probably a lot of discussion and questions that we can get through. So I'll spend about 20 minutes just sort of outlining my view around what the challenges that we are facing and what that means for the investment community before handing over to Scott, who will go into a lot more detail around specifics for the investment community and some of the modelling. So just to start with, on the next slide, please, looking at the sort of discussion that we've been having over the last 50 years or so around limits to growth. So what does climate change and all the other challenges that we face mean for GDP growth or growth in the economy more generally? So the discussion around this really started in 1972 with the Limits to Growth report. And what that was trying to do is develop a set of scenarios looking at some of the resource constraints that the world had, whether that's accessibility of cheaper oil and coal and different fossil fuels, whether that was the quality of soil around the world, so food productivity or land productivity into agriculture, or pollution into local systems. So they looked at a number of different potential limits and tried to track forward the economic activity of the day. So the bottom right there is the figures from the various scenarios that Limits to Growth were looking at, and some of the analysis they then did in 2013 when they looked back over the previous 40 years of activity. So what Limits to Growth found was that there were indeed several limits, and as Hugh was just mentioning, there are lots of limits around environment and biodiversity and land. And when you surpass those limits, then it can have a catastrophic impact on economic growth. The important, I suppose, the top level message, which they were also criticised for back in 1972, was that light blue line. So if you can see the light blue line on that curve, essentially they predicted ongoing growth in services, which is the yellow line, and all the various activities, including ongoing growth in pollution, throughout the 50 years from 1972 onwards. But then around 2030, they saw a precipitous collapse in, depending on your scenario and which resource they were looking at, either access to cheap and plentiful energy or pollution causing soil productivity to massively decrease and therefore a plummet in food availability. So essentially that light blue line is the population of the planet. So they did look at, within their scenarios, a sort of halving of global population within a 50-year period. So that was that mass starvation on a global scale. So some quite big challenges that they foresaw at the global level. Since then, lots has happened and people have been trying to understand what actually might happen and doing more work on these sort of physical limits to growth. We did some calibration of the physical limits to growth a couple of years ago. So that's the top right-hand curve, just looking at the data coming out of limits to growth and real-world data. So we calibrated the World 3 on current trends. And essentially, the limits to growth is pretty good at predicting where we would be today. There were a few things that they didn't quite get right over a 50-year period. Predominantly, that actually we have been better. We've taken some of the lessons and then managed to reduce our pollution footprint. So all of the dirty, really dirty factories we had in the 1970s have been cleaned up. So our impact on land productivity is actually not as bad as they predicted. And also our GDP is much bigger with a much smaller footprint than they saw. And that's predominantly due to the size of the finance sector. So they didn't see in 1972 a hugely expanded finance sector linked to an increased GDP activity. And therefore, because you don't have the commensurate increase in manufacturing and other industries, which are traditionally more sort of brown and add pollution, then our footprint was lower. So running their scenarios then forward, that collapse is pushed out by another 40 years or so, but there's still a collapse in this century. More recently, people have been interested in other limits to growth, like social limits to growth, in particular that 1% of the global population owns 48% of assets. Traditionally, when you have that kind of inequality, then what happens isn't global collapses, but it's local collapses. People tend to get upset and go out and have a civil unrest or protest, and so you have some sort of political impact. And also it means that you don't have the engine for growth if a lot of the wealth is just concentrated in a small part of the society. So there are lots of things that come out of social limits to growth as well, which they also didn't look at. And there seems to be this sort of limits to happiness. So this is new research looking at actually what makes us happy, what makes us prosperous. And evidence shows that at around $70,000 per year income, there is a limit to happiness. So up until that point, you increase your happiness pretty exponentially with income. So the more income you get, the more access you have to healthcare, safe and inclusive societies, all the things that make us happy. Beyond $70,000 per year, it tends to plateau. So if you have 70,000 or 700,000, your happiness is about the same. So given all these challenges, what we're now trying to do is look beyond GDP as a pure measure. We need to try and understand some of the risks within GDP and some of those other planetary boundaries, and what does that mean for our growth. So we're trying to bring in these externalities into GDP metrics. We're trying to understand what does a stagnant economy potentially do to GDP growth and investment returns, or potentially degrowth. So there's lots of research now looking at bringing in these externalities and understanding what the implications of those externalities are on GDP growth. And it's also not just an academic exercise, it's also things that governments are doing. So there's the Environment Audit Committee who are conducting a number of reviews on various aspects of this. There's the Limits to Growth All-Party Parliamentary Group in the UK government. ONS has a dashboard of these sorts of indicators, and the Wellbeing of Futures Generation Bill is now going through Parliament. So all of these things are being considered and developed and pushed forward by government. So the landscape of regulation is also starting to change. So next slide, please. We'll get the next slide. So on the next slide, hopefully that's going to appear. There we go. So when we think about climate change specifically and some of the resources that drive climate change in the energy system, then there are lots of costs and risks of not acting, of not taking heed of this, precipitous collapse as predicted by limits to growth. But even alongside that, as you get close to these limits, then things get more volatile. So whether that's the number of extreme weather events, which we're seeing increasing, and the severity of those weather events and the cost of the weather events has been increasing over the last few years, few decades, partly because of the value of infrastructure in the way of these extreme weather events is increasing, but also because the power of these extreme weather events and the number of them is also increasing. Coupled to that, we're also seeing the cost of the resources going into our system increasing. So the top right curve there is just the oil prices since the first discovery of oil. So you've seen it's been pretty stable, and that's what's driven GDP growth predominantly, is this access to cheap and available energy. And since the 1970s, we had the very volatile prices around oil, and then since the turn of the century, again, returning to these very unstable prices in oil and gas. And the bottom is just the plot of the UK natural gas for a range of different geopolitical reasons and increasing demand from China and globally. So more competition over an increasingly scarce resource. So you've got the challenge of using the resources, creating different impacts. So this increasing climatic impacts leading to social disruptions, economic disruptions, as well as the cost of those disruptions coming in, and then leading to a reduction in economic growth and all of the impacts around the lack of access to cheap and available energy. So if you look at where you're then having to spend money to keep the economy going, the resources are increasingly expensive. So we may see a reduction in the share of GDP made up by labour, and an increasing share of GDP made up of just accessing the resources. And then exactly how that translates through into inequality is really interesting to model. And then the impacts of that are quite significant. And then with the increase of the sort of extreme weather events, then you get changes in mortality and morbidity and degradation in health status, also linked into the inequality and how and what the our limited resources, what they can be used for. So big shifts potential in demographic statistics, as well as in how we live in society. So on the next slide, please. So what we're now trying to do is to look at what does this mean and how do we understand this, and the sorts of tools that we're using to make better policy decision around, especially around achieving net zero and trying to tackle some of these big challenges. So when we look at that, then the conversations we're now having with government is to move away from a pure cost benefit analysis. Essentially, it's to add a lot more information into cost benefit, but we're using the language of risk and opportunity. So there are lots of risks and opportunities in not tackling climate change, but also in tackling climate change, that transition risk. So when we go from where we are now to a zero carbon future, there's lots of risks in doing that, but a huge amount of opportunities. So we're trying to replace cost benefit analysis and standard econometric tools in the analysis so that we can really understand, where the huge economic gains are and investment returns to be made. The sort of transition to net zero is all about innovation on one side. So this sort of technology led revolution in some sectors will see significant investment returns, and our standard approaches to analyze this don't work. So how do we understand investment returns in a radically uncertain world? That's what we now need to try and do. Past growth was dependent on this cheap and abundant energy sources, and so it won't be going forward. So there are things like stranded assets and other aspects where, as the economy shifts, how we shift is really important for capital value of particular assets. So next slide, please. So in the last 10 years, a lot has changed. And if I was giving this talk sort of 5 years ago or 10 years ago, I'd be much more pessimistic about the prospect of achieving net zero. But we seem to have invented a number of industries over the last 10 years. So these are just some examples of what's happened since we've started to put in place just a small amount of policies, and the scale of change we're talking about is huge. And what we've done so far in the last decade is only the start. So what we have is an entire solar industry that's been created over the last 10 years, a global wind industry that's been created with commensurate reductions in the cost of solar, the cost of wind, so that wind is now the cheapest form of energy anywhere in the world. We've also, on the demand side, created an LED global industry, an electric vehicle global industry, and that's just the plug-in EV plot there. And there are 10 million people now working in the renewables industry. But a lot needs to change. So over the next 10 years, we need to be investing around 2 trillion per year to solve climate change, to start getting towards this net zero target. And we've kind of done the easy wins and created new industries. We now need to take them to scale. But technology won't solve everything, and so those returns on technology investments will only work if we also change behaviours and change especially modes of transport and the way we use energy, so there will be more public transport, we will cycle more, and we will walk more. So our urban centres will look very different in 20 years' time. And we will be predominantly working in different industries. So there'll be a huge jobs growth in green sectors and sectors allied to green if we're going to achieve some of these targets. So we need to invest in these wider green skills across the industry. So it's not just training up people who can install solar PV, but it's also training up the finance sector, so we understand the investment challenge that's coming along the way. And the scale of challenge shouldn't be underestimated. So this is the zero carbon targets that the government and the European Commission have signed up to. So on the left is the household energy emissions and what a net zero target means for each of those. So essentially it's taking out from where we were in 1990, we've done the easy job of making things more efficient, putting on some solar PV, having a bit of wind, and changing some behaviours. So that's the sort of easy win, taking us about halving our emissions from the home over those 30 or so years. To get to the new net zero targets in 2050, we have to essentially take that down by a huge factor. You can have a little bit of emissions in there because of the sinks in carbon, but that change is much more significant than the change we've seen over the last 30 years, and also it's harder to achieve. So the change we're going to see over the next 30 years is much more difficult. And you can kind of see that as an example of this. Is a plot of Austria's emissions over the last 30 years, so out to 2020 from 1990, and then the projection of what they need to do to meet the European Union's 2050 net zero target. So you can see for a developed country like Austria, they've been slightly increasing their emissions. UK has been slightly reducing its emissions because it's gone from coal to gas. Austria, which is a fairly efficient economy, hasn't done that switch, so it's kind of like the average country in the world. It's gone up slightly. So you can see this is an exponential decay in the amount of emissions that they can have from everything from agriculture, industry, electricity, waste management, buildings, transport. So that change is huge, and what you get left with at the end is a tiny bit for agriculture and a tiny bit for aviation if you can't electrify every plane in the world. And this is in a 30-year time horizon, so it's really big. So next slide, please. So in the UK, the government has started to think about what this means. So there's the 10-point plan for a green industrial revolution, started to invest in some infrastructure, but it's at a tiny scale compared to the opportunity there is for being a world leader in green technology. These sorts of plans and strategies and new regulations will increase over the next decade as we start to see technologies take off, or as we start to see sectors take off, whether that's on offshore wind. We're now seeing discussions about reintroducing onshore wind as it's incredibly cheap, but also where and how to install solar. The discussion around nuclear power at the moment is obviously accelerating within UK government because of the cost of nuclear, but then how we move transport over to zero emission vehicles quickly, where that involves both shifting the whole infrastructure of transport over, so filling stations, charging stations, that shift, as well as making zero emissions vehicles cheaper to buy, but also recognizing that it's a wholly different paradigm in engaging with zero emission vehicles. So the capital investment in a zero emission vehicle is much higher than in a petrol vehicle, whereas the running costs is much lower. So there's something different in the way we finance vehicles potentially, and how do we do that so that people can still access vehicles and use them, but maybe there's different ways that we can do that, different industries around rental of vehicles or different ways of financing the capital investment that you need. So we'll start seeing new industries coming up around some of these new technologies, which need more capital upfront investment than we've traditionally seen with fossil fuels, where a lot of the investment is in the fuel itself going forward. And then lots of behavior change, lots of new technologies that still need to be looked at, and investment in biodiversity and the landscape, where there's a lot of carbon capture. So how we do agriculture, how we feed ourselves, what we feed ourselves with. So all of that needs to change. So, you know, the UK government's thinking about some of these. It needs to do a lot more, as do every government in the world. There's an increasing conversation about how to coordinate this globally, because where things have been most effective, it's been the introduction of a feed-in tariff in Germany alongside subsidies for solar manufacturing in China. So you can get a massive increase in demand alongside a huge increase in supply, resulting in cheaper products, which makes the subsidies more affordable for the governments in question. So these sorts of linked bilateral discussions, but then also multilateral discussions between governments is going to become much more important. So exactly where the sectors for growth are and how they play out will be uncertain, because they involve an interplay between lots of different international bodies, national bodies, different industries, and these are going to be brand new industries. So on the next slide, please. So one of the projects we're looking at, just as an example, is this economics of energy innovation and system transition. So this is funded by the UK government and in partnership with China, India and Brazil. So we're looking at how to coordinate some of these regulations, what sort of technology choices need to be made by governments. So traditionally, governments are always have been very hesitant to pick winners, and this isn't really about picking winners, but it is about recognizing that we've got 30 years to make radical shifts in technology and in sectors. So we will need to make choices about how to invest, where to invest, whether that's nuclear power or whether that's solar or wind. So we do need to make some technology choices and be coordinated about that and work with the investment community and governments around the world to make sure that the regulation is there to underpin the investment and the investment is there to underpin the regulation. If we get that right, then costs will come down rapidly. We've already seen costs coming down exponentially for solar and wind, so they are now the cheapest. As soon as they are the cheapest, then it's more about the infrastructure you need to deploy them at scale. So that's where the investment needs to go. You no longer need to be investing in the R&D to get them to be cost competitive. So we do need to de-risk the markets to crowd in that investment to really drive down those investment costs and to build or to create the demand for the infrastructure within different countries. So that's the sort of scale that we're now looking at. And over the next 30 years, a really important part is that policies and investment strategies should be adaptive. So within this uncertain world, things will not always work out, and we will need to be able to adapt policies. Or they will work out, but we know exactly what's going to happen. Technologies will get cheaper, they don't need the same sort of subsidy, they don't need the same sort of investment as they did. So we need to be able to adapt our investment policies and move things around very quickly over the next 30 years to make sure that technology is both developed and deployed at scale. And importantly, this isn't certainly when we're looking at net zero about carbon pricing. So carbon pricing will work for some things. It will drive some energy efficiency in especially large factories or energy producers, but it's not going to drive innovation, and it's not going to drive this radical change in sectors. So finance tools need to be explicit about what they're trying to do, what the end goal is. So these sort of ideological choices behind the analysis. It's partly around, if you're looking at economic tools that come from neoclassical economics, which all look at equilibriums, then we're moving as far away from the equilibrium as we possibly can over the next 30 years. So things that, tools that measure and try and get us back to the equilibrium don't work. So when you've got radical innovation and radical uncertainty linked together, we need new tools to be able to understand the change that's coming. And we need to be able to bring those into our investment choices. I know Scott will talk a bit more about some of those tools shortly. So the final slide, please. So around investment, for actuaries, we've got sort of considering what we need to do as actuaries and what we need to change. So there's a lot of things that we need to be thinking about, and this is based on some discussions we've had and workshop we had at Staple Inn a couple of years ago. So we need a change in mindset. So what is the profession for, and how does it, what's its purpose within this net zero transition, when there's a lot of opportunities to be unlocked, but also a lot of risks. We also need to think about the skills that we deploy in this transition. So there's been a reliance on quantification, but in a radically uncertain world, we probably need to think about qualitative data and a qualitative approach to analysing some of the opportunities and risks, and move away from the sort of neoclassical economics as an underpinning ideology for a lot of the tools that have been used previously. There have been a lot of external drivers. We need to understand those external drivers. A lot of the drivers so far in finance have been voluntary, so there have been voluntary initiatives, and what we actually now need is a level playing field. We need better regulation to drive forward this transition. So the voluntary initiatives have been able to test a lot of the things we need, like risk disclosures, but we do need to move to a place where these become mandatory so that they become standard. And within the profession itself, we need to think about our decision boundaries. What is short term? We do need to be thinking a little bit more long term. How do we define long term? And also what goes into our data and modeling. So these sort of decision boundaries where we make a decision, what's the information we use to make a decision, and how do we engage with that information and knowledge, and how do we generate it? Next slide, please. So yeah, so finally, just in terms of the investments and risks, so the transition to net zero, just to re-emphasize that, it's a radical transformation of the economy. It's what we've seen over the last 20 years in terms of changing towards lower carbon and more efficient carbon has been good to test some of our systems, but it doesn't show the challenges that we're going to face in this radical transformation. However, we've started to create these industries, and we're going to see much more exponential growth and things breaking through over the next decade, and then being deployed at scale over the subsequent 20 years out to 2050. So it looks like net zero is achievable, but it will shift a lot of the way things work within society and the economy. We still face physical risks from biodiversity loss as well as climate change, and increasingly we're facing social limits to growth. So we do need to think in this transition how we manage the risks that we face. So we will see climate change impacts. There's nothing we can do about the impacts we're already facing. We'll see impacts from biodiversity loss, and unless we do something about the social limits to growth, then what we're going to do is switch from massively wealthy billionaire oil barons and countries that can use oil wealth as a geopolitical tool to renewable billionaires and individuals and countries that can use renewable technology as geopolitical tools. Traditionally, when we've had this level of inequality in society, we've had a great reset and then a great transition and a radical transformation, but they've been world wars. So we kind of want to avoid the next war as a great transition and as a great reset. We want to be able to manage this better. So we do need to do something about inequality to lower the tension in this transition, because transitions are always uncertain and have risk associated with them. So we need to think about that inequality as well. And actuaries have been thinking about inter and intragenerational fairness for a long time. So how do we use those that knowledge as well in this transition to understand that kind of issue is really important. So transition risks also exist from policy and legislative changes. So we do need to be thinking about that. How do we manage those risks and work closely with regulators so that we understand what's coming and what's going to be happening over the next 30 years. So, and just to summarize, long-term investments over 5 to 15-year period, we'll see assets exist in a radically different world, and the returns on those investments and the valuation of those investments, whether they're stranded assets, oil and coal and gas assets, or whether which will have no value or radically different value depending on exactly how we do the transition, or renewable technology, which may have very different and significantly higher valuations depending on exactly where you are in the innovation cycle. So I think that's hopefully my last slide, and I'll hand back to Hugh.
Thank you, Aled. That's given us much food for thought. I would just like to highlight to everybody that's listening, you are most welcome to drop questions into the Q&A. We will have a section on Q&A after Scott's talk, which we will then happily pick up with the questions that you fire through. Good. So next, I'd like to hand over to Scott. In Scott, we have someone who brings a practitioner's lens, one focused more on navigating the particular challenges of the financial system. And here Scott will describe to you in more detail how Baillie Gifford are factoring in the challenges of climate change in their investment process. So over to you, Scott.
Thanks very much, Hugh, and hello, everybody. I'm speaking to you today from the perspective of a multi-asset fund manager, although I've been an actuary and investment consultant in the past, so can hopefully bring some of that context to bear too. onto the first proper slide. People, you might know Baillie Gifford from your work life, or even from your own investments. If you can go past the risk factors, people don't really need to read all these. So another 2 slides on, please. So yes, we're an Edinburgh-based independent investment management firm and have been going since 1908. Myself, I've only been there since 2015, and I'm one of the lead managers on our $10 billion of absolute return multi-asset funds. So these target a cash plus return with limited volatility. Now within the next month or so, this range is going to expand to include a sustainable multi-asset fund, and the work that I'm going to show you today was pivotal in leading towards that launch. On to the next slide. All of our multi-asset funds follow the same approach. It's a patient, fundamental, flexible, and hopefully straightforward approach. We're not a hedge fund. We find that we share many of the same beliefs and tolerances as our clients, which are typically pension funds, insurers, charities, and so on. Onto the next slide. We aim to have a very wide opportunity set, investing across the full range here to benefit from the power of diversification. Things will only be in our portfolio if they can do one or more of 3 things. They can provide a return, they can diversify and hopefully also provide a good return, or from time to time they can provide a hedge if we're nervous about things that are going on in the near term. If investments can't fulfill any of those, then we'll have 0 in here. There's no sacred cows, and I'm just highlighting this to illustrate how our process works as I go on to talk about how we think about climate in that context. On to the next slide. Now, you've probably all seen 1001 investment process slides before, so I'm just going to highlight 2 key things. We start off thinking about the big picture, thinking about macro trends, economics, demographics, politics, and so on, those big top-down elements. And then we look to translate that into what we get from investing in financial markets. So in the second column that you see here are 6-monthly long-term returns expectations work. So this exercise, we call it LTRE, has always been a key part of our investment process here, and it was therefore only natural to look to expand that part of our process out to think about assessing the impact of different climate-informed scenarios on the outputs, on those return forecasts. So on to the next slide, please. So this involved blending climate and financial modelling techniques with informed assumptions about both of those to identify a focused range of possible pathways. Here we're making forecasts over the next decade and over the long terms out to 2050 and beyond. And the goal in this scenario exercise is to try to pinpoint which of the asset classes may be the most sensitive to adverse financial shocks, and which can support, possibly even benefit from some of the opportunities that lie ahead. A lot of the scenario analysis that's been done in this area has been bottom up and focusing on, are there particular companies or particular sectors of the market that stand to benefit or suffer. This is much more of a top-down exercise to start off to give us that big picture. So over onto the next slide of identifying the scenarios. Our first step was to define the scenarios that form the basis of our assessment. And that's covering both that next decade and the longer term time frame. We worked with Ortec Finance, experts in combining economic and climate related forecasts, and they helped us to define those scenario narratives and to quantify the potential financial impacts on our key macroeconomic input variables. So we decided just to focus on 3 representative climate pathways. You can think of these as examples of plausible pathways rather than specific future predictions or best or worst case scenario forecasts. The first is an orderly transition, really a quick, coordinated and predictable global action to limit global average temperature rises to 2%. Something that financial markets in this scenario price in smoothly and gradually over the course of the next few years. Perhaps this scenario is increasingly unlikely, has to be said, given what we've seen over the course of the past few years, but we've used this as our base case, reflecting our generally optimistic nature. The second scenario is the disorderly transition. Now, this results in the same real-world transition risks and opportunities as the orderly transition, but the reaction of policymakers, financial markets, technological changes is delayed until there's an abrupt realization of the problem, perhaps triggered by a sudden physical event. So that's the second scenario we've looked at. The third is a failed transition. So this is a continuation of current policies, which will just not be enough to limit global warming to 2 degrees in this particular scenario. And we're on track, therefore, for the global average temperature rising to, by 4 degrees by 2100, with a dramatic increase in the frequency and severity of physical climate impacts. Now, these scenarios may look pretty familiar to many of you. They're not too controversial. They're very clear similarities with the various IPCC scenarios that have been well publicized. So we're trying to align with that in this analysis. Over onto the next page, please. The LTR exercise, as I said, is a key part of our multi-asset investment process. That broad range of asset classes that we want to consider for investments, we want to understand the fundamentals of each of those, which is really important in assessing which will deliver good future returns and which might not. These long-term views provide context for our investment discussions within the multi-asset team, and over the long run tend to be reflected in our portfolio allocations, which I'll come to shortly. Integrating climate scenarios more directly into this exercise, therefore a very natural evolution of the process. Onto the next page. Apologies, documentation is a weird title for this next slide, but it's really relating to the process stage. And here we lay out the multiple variables and assumptions going into the model. Now, I don't need to remind an actuarial audience that that models are simple and the world is far more complex. No difference here, but it's key to know what's being tested, what types of outputs we're targeting. So you can see the parameters of our analysis laid out here. The integration of the global warming pathways, policy and technological changes, time horizons we're looking at, the geographies, all the various different asset classes, and those climate-informed macroeconomic indicators feeding into our process. And the associated outputs of these in terms of adjusted expected asset class returns. So the global warming pathways, the narratives and climate-informed macroeconomic indicators provided by Ortec, and the climate-informed indicators adjusted and fed into our long-term returns analysis framework here at Baillie Gifford. Onto the following page, we get onto the outputs. Now again, here we're estimating the likely net impacts on asset returns of climate-related events, policy developments, technological changes experienced over the next 10 years and beyond. As I said, we've aligned our baseline expectations with the orderly transition scenario. And so what we're investigating here is the asset class return sensitivities of this turning out not to be the case. In particular, what would we expect to happen if the transition were to be delayed and needs an event to kickstart the policy or technological changes? So that's the disorderly transition scenario. And what would be expected if there were no real developments, no real movement in climate commitments and technological progress? And that's really the failed transition scenario. So quite a lot laid out on this page here, but what you see is the expected returns for those core asset classes under each of the climate pathway for the next decade. As I said, there's a lot here, so we focus on the arrows. Now, for some asset classes, the dial doesn't move very much over this period, but for others, there are clear costs to delay or to failure. Over the next decade, as compared to a nice orderly transition, waiting for a shock to prompt change will be damaging for some of those traditional growth markets, partly from the physical impact. The prompt here is likely to be a large-scale physical impact event, and partly from the subsequent responses to that. The returns we show here are at global asset class levels, so net of any access costs. And so assuming that those investments are made on a passive basis. And because of that, they should be regarded possibly as minimal achievable returns. So we view these estimates as broadly sensible indications of the returns and central projections from a very wide range of possible outcomes, rather than being interpreted as high precision forecasts. Even if they do prove accurate over the long run, it's almost certain that the returns in the real world in the short to medium term will be quite different from this. And of course, these top-level asset class returns forecasts mask the underlying detail that within each of these areas, there'll inevitably be winners and losers. As Ali just talked about within equity markets, for example, there'll be outstanding opportunities for companies to be able to participate and even lead the climate transition in the coming years. Those may tend to currently be the smaller and more disruptive entities, perhaps currently outweighed in general indices by many larger but less well-prepared companies. And this is exactly why I believe that an active, forward-looking and optimistic investment approach will be able to generate returns in excess of these passive returns here. We move on to the next page. I'll show you our forecast returns over the long run. So this is going out to 2050 and beyond. And while the climate matters might not shift the dial on those expectations of the core asset classes over the course of the next decade, it's in the following decades that the investment and of course the real world impacts will be far more significantly felt. Failing to take into account the low carbon transition pathway now being over the next few years, will result in far worse investment prospects in the 2030s and beyond, as we can see here on the failed transition side of the chart in front of you. Essentially, investors today will be leaving the next generation with a far more challenging investment environment. And much more importantly, it will also coincide with the legacy of potentially irreparable physical damage and far more challenging living conditions for populations around the world, to tie it back into the natural environment that both Hugh and Alec were talking about before. Over onto the next page. At this stage, I'm trying to go from the theory of that to what it might mean in practice, how it informs and shapes our investment response. We're of course interested in the impact of these various different pathways and the total opportunity set for a multi-asset investor, be that a pension fund or insurer or fund manager. So we could analyze the impact on a single strategic asset allocation, let's say a 60-40 equity bond fund. That probably wouldn't really reflect the reality of an active and diversified multi-asset fund. So to explore the impact on the broad opportunity set, we examined the investment outcomes of the full range of possible multi-asset portfolios. And this is based on the absolutely crazy assumption that the expected returns we generated in the first part turn out to be exactly correct. So we put together a total of around 14,000 completely unique portfolios created using realistic portfolio construction guidelines, and show the range of return expectations under each of the different scenario pathways and timeframes in front of you here. So the first chart showing the range of nominal return expectations of the multi-asset class portfolio set over the next decade. And the differences here are reasonably modest at first glance. The base case scenario offers some good opportunities in infrastructure and in real estate, as well as in certain fixed income markets, leading to slightly higher median and meaningfully higher maximum returns. You can contrast that with the failed transition scenario, in which slightly better results in certain commodities and similar expected results for equity markets are offset by far weaker results forecasts for the real asset classes, or infrastructure and real estate and so on. It's on the right-hand side of this chart that you see here, where we see far bigger distinctions in the long-term numbers beyond just the next decade. Here, the impact of failed transition is clearly visible and fairly easy to imagine, I'm afraid, with significantly impaired return expectations for many of the so-called risky asset classes. Really, the multi-asset investor of the mid-21st century will almost certainly see substantially lower returns if the world follows this pathway. Putting these together, the situation is pretty clear. The cost of not getting aligned to the Paris goals in the coming years may not be fully felt by investors over that same time frame, but is likely to have a dramatic impact thereafter. So the next few years are really crucial. We're looking at it in a different way, in a slightly more positive way, that achieving the Paris targets allows the investment opportunity set to stay reasonably attractive for the long term. And that can be done with only limited impact to contemporaneous investment results. The mitigation cost need not be high, but the financial, environmental, and social benefits can be enormous. Over onto the next slide, which is my final page for today. I'm just going to end with a quick overview of our portfolio. No need for lots of detail here, but you can see a wide range of investments, and many being well aligned to making that transition, such as in renewable energy developers and operators. We talked a little bit about solar and wind in Alan's part there, as well as investments in related commodities and more modern real estate investments. Providing genuinely long-term capital to selected projects and technologies, those that are needed to make the transition, will reap benefits not only over the next few years as those benefit from the spending required to make the change, but also for the wider system in the long run. Making these types of investments today will mean a far greater chance of there being any attractive investments available to make in a decade or two's time. Thank you very much for your attention. I'm going to pass back to Hugh for a bit of a chat, and then I'll see we've got quite a lot of questions coming in. So thanks again.
Great, thank you, Scott. Very interesting presentation again. So we'll move now to a short period of Q&A between ourselves and then open up the questions to our audience. Thanks to those of you who are firing in questions as we've gone. These are going to be very interesting to bring into the conversation as we go. So it's clear there are many different factors to grapple with if we're to have any chance of thinking through the long-term impacts of the move to net zero on investment returns. Stepping right back, I think that for our audience, there's probably two separable issues. First, with our public interest hat on, we should be alive to concerns that the human-made physical system, itself a subsystem for the natural system, might be impaired in its capacity to support our global population with an adequate standard of living. Secondly, with our consultants hat on, we will want to be thoughtful about the forward-looking assumptions we might make when helping clients plan and reserve for long-term future contractual liabilities in the system. So Alan, you're in a unique position of covering both domains, and Scott, it's fair to say that you're mostly concerned with the financial system and the human physical system to the extent that it's got a direct influence on your ability to fulfill your role in the financial system. So Alan, let me start with you if I can. There's a generally accepted view that real GDP growth is required for real investment returns to be achievable. What are your thoughts on that?
Thanks, Hugh. Yeah, so I think that on aggregate, so at the global level, yeah, absolutely. You do need real GDP growth for investment returns. But when you look at actually what goes into GDP growth and what that means down at an individual level, and especially as mentioned, you know, the finance sector contributed a huge amount of GDP growth that was unexpected in the picture back in 1972. So there's still an opportunity for growth in investment in some sectors, but we do need to be thinking about actually what we measure within GDP, how we measure it, whether it's real growth that we're measuring, whether it's really measuring productivity growth, or whether it's measuring something which is just moving finance around. And does that really count as growth, or is that you know, partly inflation, partly growth linked to increases in population? So when we're thinking about GDP growth and investment return, there are still lots of opportunities for investment returns in some sectors, but if we are getting close to a limit to productivity or production growth, then we do need to think about what's the purpose of growth going forward, and that's kind of more of a philosophical question. But it's important when you're also managing portfolios, if we start to tackle some of that more philosophical question and do something about it so that we really understand what's happening in the economy.
Yeah. And just looking at the challenge of net zero in particular, some people may argue, and I know that the UK Fires research group up in Cambridge argue that we'll have to survive with a lower amount of energy flowing through the economic system. Do you think that could necessarily mean a reduction in the amount of goods and services the economic system can produce in a sustainable manner?
I would probably split that into two. So yes, in terms of the amount of goods that the economy can produce in a sustainable manner. So I do think the amount of energy flowing into the system will be lower. And I know one question that came in was around saying that now wind and solar are cheaper than oil and fossil fuels. Does that mean we can continue to rely on this cheap energy? The problem is that fossil fuels are now more expensive than they've ever been. So wind and solar isn't as cheap as oil has ever been. It's just cheaper than it is now when it's the most expensive. And we expect oil and gas to continue to rise in cost. So that shift should accelerate, but we're not going to see energy being as cheap to produce and as flexible as it used to be. So there will be a limit on energy flowing into the system. The question is whether we can grow services in a more sustainable way and actually value some of the services that we traditionally haven't valued in the past. So we've things that don't count towards GDP, like the care sector, like bringing up families, like and also, healthcare, we sort of undervalue that and overvalue energy. So if we shift our valuation towards things that help us to be more prosperous, then you've got a shift in where GDP and where returns come from, but you probably will still be making lower returns than you traditionally have, which have been driven by really cheap, almost free energy access in the past.
Scott, if I can move to you at this stage. Your work has looked at 3 different transition scenarios: the orderly transition, a disorderly transition, and the failure to transition. How does the investment process allow for large systemic risks, such as large population movements driven by the adverse effects of climate change and resource depletion?
Yeah, certainly. Thanks, Hugh. And I think this chimes with a question that I saw coming in on the Q&A feed as well about migration trends and so on. And so some of these we take into account in our process when thinking about the physical impacts and not even just when we're thinking about the climate-related elements, but the impact of migration, of big demographic trends is a key part of our processes in any case. We haven't done the study directly ourselves, but have taken a lot from other studies that have been done, which do show an increase in expected migration in the failed transition areas. So that's moving away from coastal areas, moving away from areas in which the farmland becomes less arable or less conducive to growing crops. We see those kind of changes, and that's been taken into account in the mix within those scenario pathways by Ortec Finance. A lot of those happen on a global level and over an extended period of time, so are relatively more gradual as opposed to shocks. But what we have taken into account as well is that there will be shocks. You will have an increased number of climate-related events. That's flooding, it's other weather-related elements, and that's what can have more short-term movements in our process. Can hopefully adapt to reflect that. That will have an impact directly on markets such as commodity prices, similar to resource depletion. We see crops failing for climate-related reasons or other reasons, as we're seeing it at the moment. It's a natural result of has an impact on the supply-demand imbalance and gives risks and opportunities within that.
And just staying with the concept of shocks, which you've just raised, the UNPRI talks about the inevitable policy response as a potential shock that can come through the governmental system when governments around the world suddenly realize that they're not doing enough to meet the national determined contributions to the path to net zero. How are you thinking about that within your investment process?
Well, to the extent some of these, and perhaps some of the more impactful ones, are going to come through that are going to be unexpected, and to those we might end up only being reactive. We keep a very diversified portfolio, as I showed you, and that's one way to prepare for the unexpected, as opposed to anything specific. But I think that whole question of either anticipating or reacting to large policy moves highlights the importance of being active and able to adapt an investment policy and portfolio. So as I said, we start off reasonably optimistic, and we're making decent investments in areas which are positioned to benefit from expected government spend, expected government stimulus and support. That's the build-out of renewable energies, or it's the renewable energy generation and operation, or other forms of support for those who most need it. So looking to position the portfolio in that way. But really, it's about being open-minded and flexible and ready to adapt.
Yeah, great. Thank you, Scott. And Aled, if I may just bring you in at this moment. You've been involved in the policy sphere, and I'm just wondering what your thoughts are on the risks posed by government policy, but both up and downside risks.
Yeah, I think that, I mean, they're significant, and significant from past experience as well. I mean, this is, so we, as you mentioned right at the beginning, I used to work for the Capital Markets Climate Initiative. I chaired one of their groups for the then climate change minister when it was Greg Barker. And it's always good to have an investment conversation around the importance of long-term strategies to achieve something like net zero growth. And then the following day, the minister announces a cut in subsidies for solar and destroys an entire industry overnight. So, the experience of the investment community in the EU over the last decade has been huge changes in regulation and subsidy, especially towards solar in Spain, in the UK, in the Czech Republic, sort of taking out industries overnight. So we do need to have much more stable policies, but this is where we need to have much more adaptive policies, but know what the sort of steps to adaptation are. So what's the trigger for a subsidy changing or a regulation changing? But yeah, we are going to see shocks in regulation. What we're asking governments to do is to plan ahead so that we can give people 2-3 years when a substantial shift in regulation is going to come about, so that we don't end up with either stranded assets, huge swathes of investment capital just being lost because suddenly governments say, okay, now it is too late, we need to switch off oil and gas, or a regulation that tries to create an industry overnight, which is then either too successful or not successful enough. So we do need to get better at this dialogue and adaptive policy. Yeah.
Well, just staying with the government policy for a moment, I know that something which has been a hot topic over the last few years has particularly been monetary policy, and things like quantitative easing. But in theory, at least, it seems that monetary returns are possible, as long as monetary profits are being made and financial contracts aren't being defaulted on in any systemic way. And indeed, looking at the government's response during COVID by pouring liquidity into the financial system through its effectively being liquidity provider of last resort, through CBILS loans and so on and so forth. It's had great success in keeping the economy really quite stable. So it seems like the monetary system could have quite a big impact to play, and even have an impact on the investment return environment. So do you think there's a world in which nominal and index-linked financial returns continue to be delivered whilst the physical economic system endures long-term natural system-induced disruptions and perhaps even declines?
I'll kick off if you like, and I'm sure Alad's got points to make as well. But yes, I want to be optimistic, and I want to think that returns can endure, but will likely be damaged long term, as our study showed. But markets and economies can adapt, and sometimes that's through through government intervention, sometimes through technological process. These things are really hard to forecast, of course. And while we've, like, for example, we've given some consideration during the 2010s to what would be the impact of a global pandemic, we certainly didn't predict the asset class outcomes perfectly, I'll tell you that. But that, you know, the experience of the past couple of years has shown us how, you know, government policy can underpin the resilience of markets, at least temporarily. And it's probably led to an expectation, rightly or wrongly, that policy will have a role to play. Now, of course, the situation, the climate issue we're talking about today here is far bigger and far longer lasting than COVID. So it might just be more about buying time or providing the immediate relief. And then we'll need those technological changes, those behavioral changes to come through to get through the worst cases.
Yeah, and just to add to that, I think when government is used in that way, especially around things like quantitative easing, so there's been a lot of discussion about green quantitative easing and whether QE should be targeted to, you know, if you're trying to stimulate or stabilize the economy, then you may as well do it with an eye on where you think the economy is going to be in 30 years' time. So whether you can realign some of the monetary policy to be more focused on not just stimulating or building resilience, but also unlocking the potential for growth, which would be around green innovation, green sectors. So if we can have that kind of shift, that's great. But I agree with Scott. I think that regulation will have a long-term role to play in this transition. Monetary policy probably has a much shorter term policy. The government can't be the investor of last resort and the insurer of last resort and everything else of last resort going forward. It needs to be able to play its important role and underpin and invest alongside to get good returns. But it needs to do that in a way that stabilizes the economy and not nudges it, but, you know, pushes it forcefully in the direction of travel that it wants to go. But it can't continue to do that over and over again.
Yeah, good. Thank you, Aled. And just staying in the world of ideas for a moment, Aled, if I may, you know, one of the challenges for the economics MIG is to think about new models of economic thought which could be supportive in addressing some of the challenges coming in the future. In your talk, you indicated that perhaps some aspects of the neoclassical worldview were perhaps beyond their use by date. Are there any emerging fields of economic thought which could be interesting or usefully pointed towards some of these challenges that we should be thinking about?
Yeah, absolutely. We're trying to go much more systematically through what the challenges are in the models and the modelling that have come out of neoclassical economics in particular. And the challenges around things like uncertainty, they're around innovation, they're around heterogeneity of individuals. So people behave in very different ways, especially when you're moving away from an equilibrium. So all of those challenges, they're quite well known. So the models that we currently have their place, and it's not about getting rid of them completely, or in some cases it might be, but it's about using them alongside other tools and techniques that can offer you different insights. And there are things like agent-based modeling and systems dynamic modeling. So there's things that look more at the behaviors of markets, of individuals. There's also bringing the finance sector into standard economics. Currently, finance is not in standard economics. So we need to really think about how the finance sector operates because it's such a large part of GDP now. So there are lots of different tools and particular branches of statistical analysis that can be brought into thinking about this, agent-based modeling being one of the dominant ones currently being used to try and do some of the modeling. But then also, as Scott talked about, the sort of scenario analysis and some of the more qualitative tools will be coming alongside that, and that will become increasingly important.
Great, thanks both. I'm going to start picking up some of the more of the questions from the audience. There's an interesting one here. Is there too much focus on energy at the moment? Some of the biggest residual emissions come from mindset as well, agriculture, rapid cycling of buildings, travel, waste most generally. Do the panel think that energy's been distracting us from these topics, or is it the best place to start?
I can go first. I think it's the best place to start because it's such a massive footprint, but you're absolutely right. The way we use our materials and materials throughput in the economy is critical. I mean, energy can only take you halfway, but then all the other bits need to be put in place. And there are some really interesting discussions going on within construction. You know, how do you manage health and safety so you can reuse buildings, so you can reuse steel girders, you can, you know, create Lego type buildings so you can deconstruct them and reconstruct them in site without having to have all the material throughput and all the waste. That's really important. Transport's another huge one, but modal shifts in transport are key, but also understanding the demographic shift. So, you know, when I was 18, everyone wanted to own a car. Now, children, the expectation isn't to own a car, it's to get around. So, you know, we have to also recognize what's already changed. And agriculture is the other huge one, and actually food and food choices, but all the way through the agriculture and food supply chain, there is massive changes that need to happen. So I would say start with energy, but actually most of my work now is on biodiversity and food.
Yeah, I'd agree with that. I'd point, a colleague of mine shared a really great chart from the latest IPCC report the other day, which has got a whole range of the different kind of mitigation options on it, and kind of colored bar chart of the potential contribution to emission reduction. And that helps to kind of quantify some of Alan's response there, but it also shows you a whole list. I'm looking at my screen here now, a whole list of all the different things that can be done. And you know, just to respond to the question that was asked, we do need to be thinking more broadly about those wider range of things, how we work, how we live, you know, within all sorts of different sectors.
Great, thank you, Scott. So another question, just looking at long-term investment returns and projections, and perhaps, Scott, some of your presentation, because your focus is only on that initial 10 years, you might be able to duck this question, but I think it's a good one. So often with these long-term investment projections, we see an incremental impact of climate impacts, but relatively small. And in fact, some of the numbers in your tables almost seem too small for some of the impacts which sometimes we hear in the press and in some of the written materials and media. So quite stark contrast to some of these scary climate forecasts that we see, particularly in the context of governments failing to deliver and being behind the curve. So this inevitable policy response. Is there too much black box modeling and insufficient real world scenario analysis? And how do we know where we've drawn the line in this? Perhaps that's one for both of you, because it's quite a hard one.
Thank you. Yes, yeah, there probably is too much black box analysis, and we may be guilty of it. And what I've shared with you today, you know, in trying to kind of be transparent and show these are the different things we thought about. To come to the point about sometimes it looks like it's fairly incremental. It's because markets change and adapt over these lengths of time that we're thinking about. And so, you know, we're not forecasting that, well, you know, there's massive market crashes in these particular scenarios. You know, when you run a stochastic experiment, you will get a good number of scenarios in which there are huge market crashes at kind of systemic level. So yeah, we focused on some of the kind of more central expectations and sort of representative scenarios here. The other thing I'd highlight is, you know, while the analysis that we've done here and shown is kind of top down and thinking about markets more broadly, you will see, and indeed the analysis that we've done and that others have done do show, you know, some really disruptive outcomes for, you know, when you start to do it on a more bottom-up basis for particular sectors or you know, particular areas of the real estate world, for example. That's when you start to see some of the more let's call it kind of investment to catastrophic outcomes that are perhaps a bit more aligned to, you know, what you see in the headlines.
Yeah, and just very briefly, so I mean, on the black box nature, absolutely agree. one of the challenges is really understanding what's going to happen, and a lot of the information and data is not transparent. So I think initiatives like the TCFD, so the Task Force on Climate Financial Related Disclosure, is really important to make data more transparent. But then how we use the data and what we do with it in the decision making, we also need transparency around that. So a proliferation of risk data is not going to change the world. Understanding what we do with that data and having transparency around that will help inform our decision making much more than just long lists of additional risks being disclosed. So I think we do need to move away from the black box, which means, you know, funding less consultancies and funding more academics. But I would say that.
Well, I guess part of the challenge here is as we step into this net zero world, and the transition is past going to any longer going to be a useful guide to the future, if it ever really was. So here's another question. Aled, you said that past growth was dependent on cheap and abundant energy. Given that wind power is now cheap and abundant, are you suggesting we can continue to achieve similar investment returns to the past?
So no, I think, so the important part of that is that it's now cheaper than current fossil fuels, which are more expensive than they've ever been. So they're now cost comparable, but and they will continue to get cheaper, but we're not going to be able to get the scale and the transportability of renewables. So you need a lot of infrastructure investment on top of that as well. So it needs a lot of investment over the next few decades. It's not going to be like it was 40 years ago when we had really cheap oil to drive that growth. So but it will be cheaper than oil is currently. So you'll be able to get some growth out of it, but not like it used to be. So the returns will be lower.
Great, thank you. And Scott, a question for you here, and I may be asking you to talk your own book here, but do you see a reversal of the trend towards passive investment and back towards active investment management?
Yeah, I mean, that has been a huge trend over the course of the past decade, and that's, you know, a lot more money going into those indices. And then us, as I was showing today, was, you know, showing the outlook for indices, you know, without active management. It's probably not for me to say, sitting here as an active manager, what we see in that trend. Obviously, we'd hope to see more money being more flexible, and because I think that's the that's how we get to a better situation for the long run for broader society. You know, with money flowing to the types of capital projects which are part of the transition, with money, you know, flowing away from those types of organizations, whether that's that are swimming against the tide in this. So I think that does see slightly more a need for more active management, just in terms of capital allocation. Trying to do that without talking my own book.
Great. And another question, just also related, how relevant and robust do you consider traditional asset class categorization for the world that we're moving towards?
Yeah, I saw this question coming through. I think, Ashok, thank you very much for that question. I think we will see a lot more talk about themes in investment portfolios and in trends, and just you will begin to see a bit more of a blurring of the line. However, at the end of the day, there's only really a few ways to invest. You know, you can own, you can lend, you can insure, you can speculate. Possibly some people might include leverage within that. So the traditional asset class labels do lend themselves quite well to those different ways of generating returns. And so I think there's still a role for them. But, you know, for example, we think about, you know, how we benefit from what we've called the green revolution, and, you know, we're seeing investments there within infrastructure, within equities, within credit, within commodities. You know, so we need to be able to kind of think about the world from multiple different angles, think about the portfolio from multiple different angles in order to understand the risks most importantly, but also to think about, okay, how can we benefit from the opportunities? So that's a great question. Thank you.
Great, thank you both. So we're just pushing up on time. We're at 11:25. Are there any final comments that you'd like to make just before we move to wrap up?
There was one sort of discussion that we'd had when we were preparing for this, and it was sort of thinking about what a sustainable and effective pension system sort of challenges might be given what we've been talking about today. And partly it's the kind of age-old actuarial challenges, generating enough returns to allow adequate savings. With the demise of the sort of DB pension system, we've lost some of that kind of cross-generational element of pension saving. Now, historically, that's typically been the young subsidising the old to some extent. But now, when we look out and looking forward, and I've got the question, I don't have the answer here, I'm afraid, Hugh. But we're faced with a different kind of sort of cross-generational subsidy here, because we need for today to subsidise tomorrow. In this case, and that's something of a novel challenge from an actuarial perspective, but I think it's one that we're going to have to try to find a good solution to.
Yeah, thank you, Scott. And perhaps anybody who's thinking of submitting an answer to the Reddington Prize might want to think about that, because it is a very interesting but thorny question. Aled, just coming to you for any last thoughts, comments.
Yeah, and I think I was just reflecting on some of the other questions. A question from Charles, and just in terms of if the actuarial profession started to embrace some of these new things and thinking about the challenges, who would be their clients? So I do think it would be pension funds, but also governments and businesses. So as the regulation and the economy starts to shift, more and more organizations will need to know what that shift means for them in terms of risk management, financial management, investment management. So it's probably going to be more of the same clients, but possibly more strategic and earlier on in that strategic discussion, especially within the government as they start to design regulation and policy, because they'll need to understand what the impacts of that are in terms of investment management and what expected returns are, how organizations will respond to different regulations and different risks within the transition. So it's probably similar clients, just slightly more of them.
Great. Well, thank you both, and my sincere apologies to people whose questions we haven't tabled directly. Hopefully we've touched on a lot of them and you don't feel entirely ignored. But the Economics MIG would love to engage with further in these questions and conversations. You can find us on the Institute's website, and there's instructions on how you might join the group. So thank you all for attending. I'd especially like to thank Aled and Scott for their excellent contributions and the fascinating discussion. Please do look up the members interest group on the Institute website. So if we would like to have the next slide from the event management team. Here we go. Yeah, perfect. So the final talk in this series will take place on the 10th of May. Sounds fascinating, is interesting. Is entitled "A Just Transition: Why It Matters and How Investors Can Enable It," and it will be chaired by Sandy Trust, who is the current chair of the Institute of Faculty's Sustainability Board, and he will be joined by Paul Clements Hunt, founder of the Blended Capital Group, and Adepeju Adeosun Napier, Sustainable Finance Manager at Ernst & Young. And you will be able to register for that event later today, I'm informed. Maybe you might just wait till tomorrow, but please do register. It sounds fascinating. I think will be a great talk. So that concludes the event today. I think there is another slide with a QR code, so please do scan this QR code whilst you have the chance, and we would really welcome you taking a few minutes just to provide a little bit of feedback on how you found the session today, Thank you again for joining us. It has been a great pleasure, and we'll hopefully see you at the next one. Bye.